You've probably heard some concerning news lately
Huh?
about China's economy slowing down. Their GDP growth has sunk to just 0.4% in the latest quarter, one of the lowest rates in decades. GDP, or gross domestic product for those who don't know, basically measures the value of all goods and services produced in an economy. So when GDP growth slows to a crawl, it's usually a red flag. But should we really be worried? Isn't China still growing way faster than most countries? Well, yes and no. On absolute terms, China's economy is still expanding faster than developed countries like the US, but context matters. For China, GDP growth below 5% is dangerously low based on their standards. Just look at this chart of China's GDP growth over the past 40 years. See how in the 80s and 90s, GDP growth was regularly in the double digits. We're talking 15, even 20% some years. Those go-go days helped transform China from an impoverished developing country into the world's second largest economy today. But now as the economy matures, growth is cooling off as expected. The problem is it might be cooling too quickly. Some economists think China could get stuck in a middle income trap before becoming fully developed. Countries like Brazil and Mexico hit a similar wall after initial growth spurts. So in many ways, China's economy is at a critical inflection point. How they manage the slowdown will determine whether China realizes its potential or stagnates prematurely. Now, you might be wondering, why should we care what happens with China's economy anyway? Well, here are 3 key reasons. First, China is the world's largest manufacturer and a top trading partner for most countries. A recession there would ripple through global supply chains. For example, China makes over 50% of the world's smartphones. If Chinese consumers buy fewer iPhones and Galaxy devices due to a downturn, Apple and Samsung sales would take a hit too. Second, China is the largest buyer of commodities from raw materials to agricultural goods. If demand drops, it would trigger a global commodities slump. Just imagine what a Chinese slowdown would do to Australia, Brazil, and other countries that rely on exporting iron ore, copper, soybeans, and more to China. And finally, China holds over $3 trillion in foreign reserves, owning over $1 trillion in U.S. debt. If that financial muscle weakens, it could destabilize global markets. So clearly, the health of China's economy has worldwide implications. Now that we've established why we should pay attention, let's look at what's causing this slowdown and what might happen next. There are a few key factors dragging on China's economy right now. The property market crisis. China's real estate sector has grown into a $55 trillion industry. Yes, you heard that right. Trillion with a T. But recently, property development and housing sales have dropped sharply due to a government crackdown on speculation and excessive borrowing by developers. The debt crisis. China's total debt has ballooned to over 300% of GDP, one of the highest ratios in the world. Local governments and state-owned companies are choked with debt from years of easy credit and wasteful infrastructure spending. Now the bills are coming due. The trade war, tensions with the U.S. have hurt Chinese exports and restricted access to key technology. Uncertainty from the conflict is also discouraging foreign investment. COVID-19, China's strict zero-COVID policy has led to crippling lockdowns. Although they've eased recently, the hangover effect on consumer and business activity continues. Weak household spending. Unlike the debt-fueled investment boom, domestic consumption never really took off in China. So there's no buffer as other drivers slow. So in summary, it's a toxic cocktail of financial vulnerabilities, trade conflict, pandemic management failures, and structural imbalances. Not exactly an ideal setup heading into a period of slower global growth. Speaking of toxic cocktails, let's move on to the potential impact if this downturn worsens. If China's economy continues decelerating, the most obvious effect would be companies selling goods and services in China take a hit to revenues and profit. Think Apple, Starbucks, Tesla, John Deere, big names that rely on Chinese consumers for growth. The pain wouldn't stop there. As job losses mount in China, citizens would spend and travel less overseas as well. That'll impact global tourism, education services, and luxury goods. On top of this demand destruction, suppliers of industrial metals and energy would see prices plunge as China buys less raw materials. That's bad news for commodity exporters like Canada, Brazil, and South Africa, who send a ton of natural resources to China. With earnings shrinking everywhere, stock markets around the world would likely swoon in reaction. And if Chinese investors start selling off their enormous overseas assets to raise cash back home, financial contagion could spread rapidly. But this doom and gloom scenario isn't guaranteed yet, because unlike stock prices, economic futures depend on human choices. Although past performance doesn't guarantee future results, examining how Beijing has handled prior downturns provides clues to what could happen next. The Chinese government has intervened heavily in the economy for decades to maintain rapid growth and social stability. Whenever the economy showed signs of weakening, China pulled levers like flooding the system with cheap credit, approving massive infrastructure projects, relaxing rules on shadow financing, ramping up exports with competitive currency devaluation. In essence, more debt-fueled construction and more exports were the traditional game plan. But therein lies the problem. Those tools might be losing their effectiveness. China is already saturated with underutilized infrastructure like airports, rail lines, and entire ghost cities. And with the rest of the world slowing and trade tensions high, relying on ramped-up exports seems unlikely to work. So what about monetary and fiscal stimulus, the classic response? Well, with debt levels already at all-time highs, China has limited room to juice growth through massive government spending. The last thing Beijing wants is to add to the debt hangover, and with the currency facing downward pressure, there are risks of capital flight, so China can't slash interest rates aggressively. Then what options remain? 1. Encourage more domestic consumption to offset weak investment, exports, and real estate activity. Easier said than done, though. 2. Restructure inefficient state-owned companies and unshackle the private sector to unlock productivity and innovation, but that risks unemployment and social unrest. And finally, China could slow the pace of its common prosperity policies aimed at redistributing wealth. But Xi and the party have hung their hat on that drive. As you can see, China's options involve difficult trade-offs. There are no easy ways out. With the right reforms, China can still secure its footing for the long run. But the clock is ticking. Tough choices need to be made soon before things spin out of control. The coming year may determine whether China remains stuck in the middle or lives up to its full economic potential. These waters won't be smooth sailing, but let's hope Beijing has its hand on the tilt. So, in closing, China's weakened economy presents risks, but also opportunities to invest globally for those paying attention. What companies and countries could benefit if China looks inward or consumer spending shifts away from Chinese goods? Which ones may need to trim the sails if exports to China dry up? Lots to ponder. All right, so that wraps up this video on China's downshifted economy. Please subscribe and hit the like button if you enjoyed the video. See you next time.